Alrighty, welcome everyone. We're gonna get this out of the way. Da, da, da. And here we go. Alright, understanding options lingo. This is Armor Bull Trading. I'm James Nash. Welcome. This is going to be a breakdown of all the popular terms, especially if you're new. This will help you understand options lingo a little better. So when people are throwing around, or if I'm explaining something to you, or somebody else is explaining something that has to do with options, you will grasp a little better if you can understand, or at least have a base knowledge of what these, terms that are often used are. Of course, we have the disclaimer. Don't think because this is available to you being taught by me that this is financial advice, trading advice, direct or indirect direction to trade or not to trade any particular stocks, ETFs, or any other financial assets or classes. This video is created 100% for educational and entertainment purposes, providing you with information on certain assets that you can find on your own. I've done the guesswork and found them already. There are so many more options and good mentions, but these are my picks. By continuing this video and presentation, you accept this disclaimer, stop the video, or discontinue watching if you do not agree. Now, this disclaimer is universal to most of my videos, so disregard the part about, these are my picks, etc., unless we do go over stocks, in which you, of course, will regard this. So sometimes I get carried away and I'll start talking about certain stocks or assets, etc. So here we go. Let us start with what options are in a general sense, okay? A stock option is a contract with a value based on the current price of the stock. In this scenario, the stock is called the underlying asset. Generally, the contract value changes based on the stock's price movement up or down, or even no movement at all. Contracts can seem very confusing or difficult to comprehend at first. However, once you catch the light bulb of how it all comes together, then you will be square for sure. A more refined definition would be a stock option is a contract agreement that gives the buyer the right, but not the obligation, to buy or sell the underlying asset or stock. The contract agreement also has a predetermined expiration date at which the contract ends and the desired outcome is reached by the winning party. All right. A call option. This is basically kind of broken down library encyclopedia version, and then we'll go over some other things a little later. A call option is a direction play on the stock to where you believe based on your analysis that the stock will increase in value. All right, a put option is a directional play on the stock as well to where you believe based on your analysis that the stock will decrease in value. A contract, in general, an agreement between a buyer and a seller against an underlying asset. This can be a stock, an ETF, Bitcoin, could be futures on corn or gold or et cetera, et cetera. This asset could be anywhere from gold, futures, stocks, options to corn. Okay. Expiration. The expiration is the date that was agreed on for the underlying asset to be at, above, or below. Strike. Strike is the price that you select for your option, the price at which you believe the price will hit or become close to. The bid-ask spread. Now, this is very important. The bid-ask spread is the price at which buyers and sellers spread their love. The bid-ask spread of price is one of the most important parts of an option and to stock price fluctuation. Essentially, if the buyer does not want to sell the option or stock at set price and nobody budges, the seller will win because you want to get in that. That is fine. You should not be getting into a position anyways if you're scared to pay just a little extra. Now, there's another term we'll go across in a minute, but let me touch back on this bid-ask spread real quick. Market makers, aka people who actually make the trades happen, people who connect them, clearinghouses, etc., etc. They are actually the ones who get the profit in between that bid ask. So if somebody's asking for 87.50 and they don't want to sell it except for 87.55. So if they can push you to get that 55, the market maker gets the in-between in some cases and or commissions in general. Okay. Slippage is another term used in bid-ask. Slippage. Slippage is a trader's worst nightmare also, ultimately, but Also, not always a bad thing. In some cases, the slippage gets applied to the opposite side. So if I say I want said option at $55, but the price is 60, if the buyer changes their mind and just wants to get out of the position, they will undercut the bid and the buyer will get the price improvement benefit. However, in most cases, the seller gets the benefit. Premium. Premium is the part of the option that tells you how much you'll pay or be credited on an option. For example, you can buy an option and pay a premium, aka you pay a debit, or you can sell an option and collect a premium, and you're collecting a credit. So a debit is when you pay the premium, and credit is when you're paid a premium. Spread options, not to be confused with bid-ask spread. Spread options are different types of option strategies that can mitigate risk and show you much more clear picture of profit and loss potential. These are my specialty. This is what I've been working on for the last 3 years of trading. Specifically in the last 3 years of my 4 years of trading. Debit spread. A debit spread is a neutral to directional position that just makes sense when it comes to trading smart. We will go into detail on debit spreads in another video. Calendar spread. A calendar spread is a neutral to strongly directional position depending on how you build it. Same can be said for that debit spread. This trade also just makes sense when it comes to trading safe and smart. We'll go into great detail on calendar spreads in another video as well. Most likely I'll make a mastering spreads video to kind of collaborate with the books. So you'll have the books and you'll have all these webinar videos that I'll be doing now. Okay. Straddle. A straddle option is an option that where you simultaneously buy a call and a put for the same strike price and same expiration. Yes, you can purchase them separately or together as one position. And in some cases, you can modify it a little more. You can make a double straddle and things like that. Strangle is an option where you buy a call and a put option for a higher strike call and a lower strike for the put. Yes, they can be built together or separately as well. Also, they can be on a different expiration if you choose. This can also be a good form of a hedge in the event of a large move out of nowhere. The straddle can be built the same way. Okay. Buy to open. This is very important. Buying to open is when you're paying a debit for a position to be opened, such as buying a call or buying a put or buying a strangle or a straddle or other type of debit spread. Remember, debit means you pay for it, just like with your debit card. Again, you're buying to open. Now, selling to open, of course, is the opposite. Selling to open is when you're receiving a credit premium for a position by selling it to the market, such as a credit spread, selling covered calls, or selling cash covered puts, as we talk about in another book that I wrote. I haven't edited most of this writing, it's just for this presentation purposes, but my book I have a book on selling cash covered puts, a book on selling covered calls, and mastering spreads book as well. I do not like credit spreads, and if you know me for any amount of time in the last year or so, you'll know why. Please explore the YouTube channel I have, Armor Bull Trading, and you will discover why. It's like you receive a credit from a credit card. It is not your money up front until you have paid it back, and then you realize the expense. Likewise, with the option, you don't realize the credit until you close the position. So in the event that the position goes your way, right, say it's a bull put spread, and the price has to increase to X amount, the credit you receive, if you're correct, and the price closes, you're good to go and you keep your credit. Otherwise, the collateral that you put up on that credit is going to affect you, and you'll probably lose some money. Buying to close is the opposite of buying to open, and likewise the counterpart to selling to open. So if you sold to open something, you have to buy it to close it. So buying to close is the act of buying back the position you sold to open because you received a credit. So now you have to buy back with a debit to end it, okay, to close the position. Now, generally your credit, say you receive a credit for $85. You would love to buy that credit back for 50 or 20 or even $1. So that way you receive the entire amount of the credit. Never ever let an option run to expiration unless you are very familiar with options at that point and you understand what the risks are at expiration. Now we have the Greeks. Very, very confusing to most people. Greeks are the pieces of an option contract that decide all of its values. Now this can get very detailed, but ultimately they measure the sensitivity of the options contracts and how to approach particular contracts based on the values they provide. So simple explanations below. Before we move to the next explanation there, let's make sure you understand what in the money, at the money, and out of the money means. So you need to know what these common terms are as well for options. ITM, or in the money, option strikes already under the current stock price for calls and above the current stock price for puts. All right, at the money, or ATM, because the strikes are right at the current stock price. Best overall option strikes for the best returns overall, pretty much. I actually calculated this out with out of the money versus at the money the other day on a specific move, using the same amount of money to purchase X amount of out of the money options and X amount of at the money options. And the at the money options actually increased 100% higher than the out of the money options. That is extremely beneficial if you need to know that. And if you're countering yourself with, should I buy out of the money or at the money? And then OTM, as we just mentioned, out of the money, the strikes are far away from the current stock price. All right, now back to the Greeks. The top 5 Greeks, there are more than 5 actually, but nobody really ever talks about them. In most cases, they're not really necessary. Extremely advanced options traders may use all the other Greeks, but for us, we do not worry about that, and to me, they're mostly irrelevant. The top 5 Greeks we utilize sometimes in options trading and spread trading are delta, theta, gamma, vega, and rho. Delta is the price increase for every dollar move in the direction of your call or put. And the money or at the money, again, is generally the best deltas. So you'll get more increase for your money every dollar move. So if Apple goes from 145 to 146 and the delta is 50, you would make $50 for that $1 move. Okay, moving on. Theta is the daily time value decay, aka time decay, of the option. Weekends and trading holidays are generally already calculated into the theta value. So you don't really have to worry about the weekend losing an additional amount or trading holidays losing an additional amount. They're already factored into the option, think months in advance. Gamma is the rate of change for an option's delta. Never really look at this. Vega measures an option's sensitivities to implied volatility, or IV. I really don't look at that either. And rho, I certainly don't look at. Measures the expected change in an option's price per 1% point change in interest rates like treasury bills, and I never really use that. Moving on. Implied volatility, as we just mentioned, aka IV, is used to project future price moves of options contracts. If the IV is very high, this often insinuates a large move is projected, and it is often priced into the options premium. The higher the IV, the more jacked up the contract prices are likely to be. In bear markets, it is often realized that IV stays high, and in bullish markets, it tends to retreat a little until you have a massive move or some serious price action that changes the IV to make it increase in IV on the high side. IV is very important when it comes to selling options or in a unit or leg together set from different option strikes and expirations, which gives us a spread that has high reflection from IV. If I open a calendar spread, I want IV to be very high for my short leg option I sell. But why? Well, because when I split my expirations, I will buy the long call or put at least 1 month away from the sold short leg. This practically guarantees me that discount of my longs by crediting me the short when it expires, hopefully worthless. But again, we don't really let options, I don't promote to let options expire completely on the contract. I prefer to close it or buy it back, before close of market on that expiration day. Hopefully they become worthless at the short chosen expiration. More detail in the calendar spread video that will happen, not chapter. But unless you have my book, then you'll know exactly what you're reading. And historical volatility is a counterpart to implied volatility. Historical volatility sort of goes hand in hand, but it's the measure of a stock or asset's price range from its mean average value, so its average true range of the price, Usually the second to third deviations get the HV numbers up pretty high, which makes that stock or asset a lot more risky. However, sometimes risk can be a good thing. So if you trade options, not only can you buy calls for increase in price, but you can buy puts for when the price goes down. And you know what we all love? Thank you. I hope you enjoyed this short video on basic lingo of options. And I'll move over to Robinhood online to show you the options chain and a few of the things we talked about. And you know what we all aim for in the end? 10 days. All right. Now we'll exit this short part of the video, moving over here to Robinhood. And we'll start with AMC. All righty. So this, what you're looking at is an option chain. Now, the way this is laid out is very simple, very user-friendly. You have all your expirations available here. The nearest expiration is July 30, so that's the first one you're at right now. So you need to be very careful when you're trading options, especially if you have same-day trade enabled on Robinhood. And if you're using TD Ameritrade or Fidelity and all that, they automatically prompt to the first expiration. So make sure you don't accidentally day trade, okay, if you're not planning on it. So this is 2 days away. Now you can see that these premiums are basically nothing. They're worthless. Now if you expected AMC to jump, up to say, it's at 37.80, so if you expected it to jump to $50 tomorrow, or by Friday, you could get this option here for $22. 22 cents times 100 shares, that's $22. Always calculate it that way. Don't ever think it's 22 cents. You will confuse yourself. If you have 22 cents in your account, like for example, my buying power in this currently is $1.43. I do not have enough to buy this $22 contract because that's $22, not 22 cents. Okay. As we were talking about Delta, here's your Greeks. So we got Delta, Gamma, Theta, Vega, and Rho. Okay. Delta is $7.65 per dollar move. So in the event that we buy this $50 call and AMC goes to $40, we'll say that's a roughly $2.20 increase. So we'll only make $14 on that contract. Now, with Theta being $20 a day and your delta is only $7 a day, you'll practically lose all the value of this contract if nothing happens on AMC tomorrow, which would be Thursday. Well, technically Wednesday. So by Thursday, your option will be roughly worthless. There's 14,900 open interest. More than likely, those are sold calls, but it is possible that they're bought. People trying to get happy on the lotto calls there. Now it's funny because in the event that the squeeze occurred and somebody got real crazy, say they bought, these $2 options up here, say $100 strike for $3, and they bought 100 of them, cost them, a little bit of money, no big deal, $300. And then all of a sudden, you can see the implied volatility is 440%, which is pretty darn high. Say they bought, 100 of these, and then all of a sudden the price shoots up to $95. You'd have the options shoot up somewhere in this range. Okay. So you would turn $3 into 300 times 100. I mean, that's quite a lot of money there compared to what you paid for the position. So now, obviously, that's gambling, so we do not promote that at all. Say if you go to a later expiration, you can clearly see the premiums are much, much more expensive, even all the way back at 100. They are still looking at $64, which is actually not a bad risk to reward overall if the squeeze did start to occur. But it's not worth buying options like that because if you look at the delta, it's only $8, right? So remember we said at the money, in the money, and out of the money. This is certainly out of the money considering the price is $37. All right, if you click that, it takes you right back. So these are going to be in the money, okay? And then right here is going to be at the money. I normally say within $5 or so. So that's going to be at the money here. And once you really step away from 45, you're definitely out of the money at that point because AMC can make a $5 or $6 move in a day, no big deal. And of course, you can click over to puts, and you can see puts you got a lot of value in these puts here. And this is only for August 20, so approximately a month away. Now, let me just show you an example of a bid-ask spread. So if you click on this, you can see the bid is 635, the ask is 645. That's a $10 spread. So your average is 640 between those two prices, right? Now watch this. So we add this option here. We want to buy that call for 38, and we want to sell a call for the previous week expiration, also at 38. And we just deduced our total expense here to $97. And it actually tells you that if AMC price stays above 32 and below 45, you will make profit no matter what, because you're collecting all that credit right here from this option. Now, granted, you do have to have access to trade spreads and event spreads, etc. So make sure that you know exactly what it is you're doing. I do teach you how to do all these things. Do not trade credit spreads. They are retarded and a complete waste of time. Debit spreads give you the exact same risk to reward ratios, and you also likewise know exactly what you're risking and have no additional risk with collateral. All right. Now, again, with that bid-ask spread, look over here on the right. So you see this 80 to 115. So that's a much more dramatic bid-ask spread, right? Because now you have two options that you're actually changing up. So this is $25 difference here, and your 543 mark. So you have a much larger difference in your bid-ask on the spreads. So in this scenario, it's very important. You can attempt to get filled at 95. It's going to prompt you to click 95. Or you can go ahead and just put 100. Okay, so just put 1. And then when you go to review, obviously I don't have enough money in there. But what it's going to do is tell you. See, watch this. Let's see if it gives me the. Okay, it won't do it. So generally, it'll tell you, depending on the option, it'll tell you that you have to put it in a multiple of 5. So it has to be 95 or 100, 105, etc. So being that it's 98, I'm not going to worry about $2. If I think this option spread can make money, I'm going to go ahead and put my $100 in there and lose $2. Because chances are when I fill at 100, if it doesn't fill right away, I'm going to cancel and I'm going to get back in, because my target, if my potential profit is $250, because I think AMC is going to stay flat, say for the next 2 days, and I'm going in, I'm not going to really worry about $2. Okay, and I said 2 days. I'm sorry, I meant like 2 weeks roughly. Let's go back here. So let's break it down a little differently. Let's go with the most recent expirations. So let's buy this call at 38, and then we're going to sell the 6th, which is next Friday, and we'll sell a $39 call. Now look at your profit change here. So you got 230, right? Because you have $360. Now if you look at it, that's almost the difference here between the two. So let's go back. Now look at this. Your max profit's only 218 because we closed the spread back down, but your credit is higher, but your total cost is only $135. Okay, so we continue. So you got 120 to 150, 135, 140, maybe 142 would get you in that trade pretty quickly. And then you're just sitting on it waiting. So the good news with Theta is that it moves so fast. See, right here is 195. So let's go back here. All right, let's buy the 6th. And we're just going to show you the bid-ask spread a little more here. All right, go to 30. This actually, same stuff will be on the advanced spread class. So the most you can make on this trade is 136. Now, why is that? Because the trade is much safer. Because, okay, if it's not over 38, because technically it's out of the money right now, it's 37.80. And if it stays below 38, you'll get this whole $195 as credit, and your total cost for next Friday is only $400. So if this expires in 2 days, 3 days now, and it goes worthless, or you buy it back for say $5, but then next week, say Monday or Tuesday, AMC jumps up to 40 or $50, guess what? This is going to increase in value, and you've collected that $200, and all you have to do is get a little higher than what you paid for this one technically, and you'll have made probably 130 or more in profit. All right, so let's cancel that out. So I showed you the Greeks. Now let's show you the in the money Greeks. So at the money is $50 delta, right? So you're only losing 38 per day on this $2. I'm sorry, 2-day expiration. Let's go to August 20. This is why I promote 1 month, right? Watch this. So let's just go August 27. That's almost exactly a month away. All right, look at this at the money. You got almost $60 that you make for every $1 that AMC moves. Now, it doesn't matter, it shows the same Greeks as far as that goes, but it just shows you your probability, chance of profit, and all that good stuff. But at the money, which is one strike off, 37.80, so $38 is the first one there. So your Greek is $60 for every $1 it moves. So it goes 38 to 40. That's $120 you'll make from here to here. Okay, but this option is $723. Okay, now let's look at in the money. You're right there about the same. So let's say most people that trade in the money go a few dollars in the money. So we're on a slight downtrend. 34, 32 seems to be the safe spot. So you're paying $900, but you're at 70 now. So once you get about $10 in the money, you'll be at a really, really high delta. Yeah, so 80 delta. This is actually what most options teachers will teach you to go for when you're buying calls, is go for 0.80 because it's the most probability of being in the money. Now the problem is, if this is $1,248 and you're losing $8 a day, and you're at 28, you really, really need this price to increase ASAP. But now here's the thing. Watch this. At $28 in the money, $1,248. Now watch this. This is the power of expiration. Let's go 2 years out from now. Well, a year and a half, I guess. January 20th, 2023. Look at these options. Look at this. Why in the blue heck would you spend $1,200 on an option at the money? Matter of fact, I have one of these. So I'll actually make $60 or $56.65 for every single dollar that AMC moves up to this point. And then once it gets over 85, this delta will increase slowly but surely, and it'll increase probably to around 80 or 90 once we get about to this $95 to $100 range. And this is, of course, the squeeze. But why would I pay $1,200 for an option that's a month away when I can pay the same thing? Yes, I'm going $40 or so out of the money, but I have a year and a half to my expiration time. And if we go over here to Thinkorswim and we pull up AMC real quick, we can see that when this first initial happened, this hit 20 plus, and then now over here we hit $77. Okay, that's a huge jump. And then we touch 60 again, somewhere in this range, 64 there. Okay, so all we have to do, we got a nice support bottom happening here, and as long as we push back up and continue to push up, and we break out of this little trend going on, that's the 4 hour. Let me go to the 3-day. Yeah, that's a lot better. So my CCI is giving a nice curl down, and this may fan out. I mean, this could take weeks, it could take months, but we have a nice go. We got indecision on these candles here, but there's a lot of short pressure. But the issue is for the shorts is once we burst through this again, we're heading toward the ceiling, in my opinion. So in that event, I literally have all the way over here, like even further. Matter of fact, let's see. Yeah, this doesn't even, this only goes to August. Let's go further. Yeah, here we go. Yeah, 2023. That's monthly. Let me go to weekly. Max weekly. Well, I guess they don't want me to go that far. So anyway, yeah. So I would go to all the way to over here on this year chart wise. So that's a whole 1.5 years that I have for me. So I got all of 2022, and then all the way up here to 2021, and we're in July right now. So that's the power of expiration. That's why you don't buy short-term contracts, because it's just stupid. Even day trading, why would you buy a 2-day expiration unless you're literally scalping it like a $2 or $5 move, okay, yeah, you can make money, don't get me wrong. But at the same time, you negatively impact yourself, because check this out. When this EMA crossed over, this is a daily chart, right? Let's see. Go to the daily. Let's just use this as an example. So in this daily chart, right, when these EMAs crossed over, and then they crossed over the 50, and it gave you a solid buy line, right? Say worst case, you waited to enter here when the I think this is a 13 EMA crossed over the 50. So your price is at $43. So if you day traded this, okay, so say it opened at 41 and you sold at 43, or maybe even swung it to the next day and you sold at 44, almost $45. But if you bought a 2-month expiration, guess what? You ran this baby all the way to $55. That is the power of expiration. So generally 3 to 4 months is your best thing for calls, right? So we got a huge drip on this Neo right here. This is a massive bearish engulfing candle. So this could be really good for us coming soon here. Now what we have to watch for is to make sure the EMAs continue to cross down. And if they do, we'll probably touch this level down here at 34, maybe 32. And once we break below that, this is where we're at right here. So we got these low tests, that's 30. And we got this low test over here is 31. So 31, 30, chances are this will tap 29 and it should bounce again. All right. So I think that's going to be all. I think we pretty much covered it. I hope you all enjoyed this video. I tried to keep it fairly short. Thank you so much for watching. Hope you learned something. Hope you got some good stuff from this video. More to come. Thank you so much.